Good morning. Welcome to our webinar. Thank you everyone for joining today, and a special thank you to our two panelists, Jesse Proudman and Yuriy Anosov, for coming in. We're going to be discussing the current state of crypto, the recent Bitcoin halving, the custodial landscape, and then opening it up for Q&A at the end of the session. I'm very excited to have them both here, and I will pass it over to the two of them to let them introduce themselves. Jesse?
So I'm Jesse Proudman. I'm co-founder and CEO of Strix Leviathan. I'm a longtime entrepreneur, started my last company in 2003, a company called Blue Box here in Seattle. Sold that company to IBM in June of 2015 and spent 2.5 years as a distinguished engineer, first year and a half working on integrating the product with IBM Cloud. And then the last year, basically 2017, was working with IBM Ventures to work to launch a blockchain-focused accelerator for the broader IBM company. Concluded at the end of 2017, there was no capital to launch that accelerator, and knew I wanted to do something in this space, and had began to form a thesis around applicability of algorithmic trading, really as a function of the speculative nature of this asset class and of the transparent market data and fractured liquidity that existed here. And so started Strix Leviathan in January of 2018 to do two things. One, to build a complete end-to-end software platform to allow quantitatively traded funds to effectively operate in the space. And two, to launch a quantitative hedge fund using that software to trade a pooled investment vehicle.
Yeah, thanks, Jesse. And my name is Yuriy Anosov. I've been with Anchorage since August, so about 9 months now. I'm in charge of building out the brokerage unit here and offer a lot of trading services for our custody clients. Before I joined Anchorage, I was at a crypto quant fund called Galois Capital. I was there for about 1.5 years. Did a lot of OTC, some algo market making, other quant strategies as well. And then prior to my crypto life, I spent about 10 years at Goldman Sachs. Most recently, I was a money markets portfolio manager for the asset management unit, and also functioned as a repo trader for some of our fixed income macro hedge funds.
Nice. Jesse, a follow-up question to your intro. Can you tell us what Strix Leviathan is?
Yeah, what Strix Leviathan is. Yeah, so
Sorry,
it's all good. Everybody gets it wrong, which is why we had to buy strixfund.com. I can't even spell the company name sometimes. So a Strix is sort of a mythical owl of the night, and a Leviathan is a sea monster. And so from our perspective, our job is to be sort of all watching, all listening, and then multitasking with the big brain. And so sort of owls are always listening, always watching, sort of represent the observation component of what we're doing, and then an octopus or a Leviathan, sort of 8 arms, multitasking, big brain, being able to respond and react quickly to what the markets are doing. So we've been able to play off that imagery in our company name.
Nice. With that, I will jump into the topics. So to start, in crypto, there's a popular notion that given current central bank stimulus policies, the macro environment is bullish for Bitcoin and other digital assets, and that more funds and individuals are starting to see the risks in fiat currency. What's your take on this, and what should institutional investors make of this current climate? Yuriy, we'll start with you.
Thank you. Yeah, so the way I would answer this question is, if we look at just kind of what's going on in March, right? So due to COVID and some of the other kind of macro reasons, the Federal Reserve has decided that they will expand their balance sheet, print a lot of money, and basically do all these kind of inflationary things that are, completely under the control of the Fed, and they're the ones that are deciding to do this and executing on these policies, right? And then with Bitcoin, quite the opposite happened, right? We had the halving, which we're going to probably touch on later in this webinar in more detail, but Bitcoin, the amount of Bitcoin that's being produced is actually getting smaller, right? So you have these kind of dichotomy of events, which makes Bitcoin more scarce, while it makes the US dollar more plentiful. And, just basic supply-demand economics, you kind of see the issue there. So, that plus the fact that, Bitcoin is more transparent, a lot of other cryptographic aspects of Bitcoin have been developed so that there's no double spending. It's easy to transfer. You can store it pretty efficiently. I think makes Bitcoin probably a more realistic monetary exchange of medium kind of in the future compared to fiat, in my opinion.
Yeah, that's a great question. I think there's two things that are really important to touch on here. The first is the reality that the US dollar is the global reserve currency of the world. And I think a lot of folks in crypto will make the argument that sort of all of the quantitative easing that's occurring right now will have pretty major inflationary impacts on the US dollar. But the reality is that there is significant demand for the dollar globally. So we, to some extent, do have the ability to continue to print money. And we're sort of in the midst of this big global experiment to see how far that can go before it really begins to impact, from an inflationary perspective, the value of the dollar. So I think there's no right answer here. This is an experiment, and we'll see how it plays out. But we can't just say because of QE we're going to see big inflation, and thus everybody should put capital into sort of hard assets like gold or Bitcoin. I don't think that's sort of necessarily the right answer. And that's manifesting itself, I think, in the stock market to some extent, which plays into my second point, which is where does net new capital come from in this space? So the price of Bitcoin goes up when net new capital is entering the space, and the price of Bitcoin goes down as net new capital leaves the space. And in the 2017 bull market, most of that net new capital was coming from retail traders, sort of the everyday person getting on all of these individual exchanges and buying and selling these assets. Today, I think you're seeing a lot of those retail traders use platforms like Robinhood to trade the traditional stock market. And I think if you look at returns of sort of some of the FANG stocks or things like Tesla or Zoom over the last number of months, the returns sort of mirror the same profile that many people went to crypto looking for, sort of 100% returns over a course of a few months. And so I think the reality is it's much, much easier to use a platform like Robinhood, where you're buying sort of stocks that are simple to understand and that sit in an account. You don't have to understand all of the nuances of the technology and of wallets that exist in this space. So I think the lack of retail traders over the last couple months, or the lack of new retail traders over the last couple months, has had a pretty big impact on price action in the broader cryptocurrency space. So those two pieces combined, I think, have been pretty fascinating dynamic to watch this year.
Sure, and look, I'll actually take a completely different approach to this question, and I think that one of the things that the digital markets really bring, that I think is a big upgrade to the traditional markets, is everything that kind of happens in the back end. As a traditional trader, let's just use a retail example. You buy a share of Boeing on E-Trade, and it appears in your account, right? But what really happens, like, on the back end, right? Like, what does your E-Trade do? Like, how does it actually buy those shares? Like, how does it go to the brokers? Like, how do those brokers actually get the shares transferred and, to your brokerage, and then to be in your benefit? And then on the institutional level, the same kind of thing happens. And, if you're somebody that's been on an institutional trading desk, that because of, the SWIFT system, the faxes, all the, human elements as far as like operations departments, transfer agents, custodians, folks in DCCC, you have errors just basically all the time. There's tons of fails, there's tons of charges, and I can kind of keep going, right? Now, in the digital markets, things are very easy as far as doing a lot of these back-end type things, right? Like when I send Jesse a Bitcoin, I whitelist his address, I press transfer, and he kind of gets it right away, 10, 20 minutes, however, 30 minutes if we have like 3 block confirms for him to be fully the full owner of these things. And I think a lot of the back end is really what I think is truly promising and is very unique to digital markets, that I think will just make the whole financial system more efficient once there's kind of more of a mass adoption away from SWIFT, which, by the way, was created, I think, in the 70s and had a lot of the mass adoption in the 80s. So it's quite an old system. It's definitely pre-internet as we know it today.
Nice. And continuing on with demand, given both your professional backgrounds and areas of focus in your companies, you each have a different perspective, obviously, as we can see in that past question on the space. Right now, what are you seeing in terms of demand for exposure to digital assets, and kind of where is that demand coming from?
So, yeah, I'll take a first stab at this one. So, when I think about, like what type of player is kind of like a large buyer of crypto. Okay, so obviously the easy answer is somebody that wants to hold it. That's kind of something that, as Jesse and I touched on earlier, that will see Bitcoin kind of go up, and that'll be their new store of wealth. But what I've really been seeing lately is that traditional macro investors, whenever they see some sort of distress in the markets, they look to hedge away from traditional sources, bonds, equities, real estate, etc. Right? So the usual thing to do is go buy precious metals, right? Go buy gold, go buy silver. Now, I used to be under the impression that, all right, well, if folks buy gold, we need to convince them to go buy Bitcoin, because gold and Bitcoin are not very correlated, and we should attack it that way, right? But what I've seen lately is that folks are looking at Bitcoin and gold as complementary assets. And while a macro fund might buy a bunch of gold to hedge against all the other asset classes, now they might look at, all right, I have my pie, that's my hedge. Right? And out of that pie, maybe 90% will go to gold, and maybe 10% will go to Bitcoin. Or maybe it's 95% and 5%. Either way, I think Bitcoin is being taken a little bit more seriously by folks looking to just hedge against everything that's kind of going on in the macro space.
Yeah, it's interesting. From our perspective, most of our clients are family offices, high net worth individuals, sort of tech entrepreneurs, that group of individual. I think many of them arguably look at this as an interesting experiment. Like they're thinking about it certainly as a way to gain access to an asset class that is sort of outside the bounds of the traditional financial system, but they're also just interested in the technology itself and sort of everything that's happening here. And so sort of an investment in this space to some extent is designed to scratch that curiosity. What is Bitcoin? What are all these assets? How do they behave? And why are they interesting? Like we spend a lot of time talking with prospective LPs around those areas. How do we think about the space? How do we think we can generate return from the space? It's not necessarily just about sort of coming up with a hedge for the rest of the market, but it's really, there's something new here. It's really interesting to people, and they want exposure in a smarter way than just buying straight spot coin.
And since you both have been in this space for about 2.5 years, what has changed in terms of the forces driving demand when you first initially started in the space to now? Jesse.
Yeah, I can touch on that. So I think, again, and I was briefly highlighting this earlier, 2017 was predominantly driven by retail investors. It was a frenzy and a mania, unlike anything we'll likely see again in this space. And the challenge there is that for many individuals that continue to hold through December into January, February, and through the rest of 2018, many people got burned pretty badly, particularly those that entered late in 2017. So this is a space where drawdowns of sort of 50 to 80% are not unusual. They're common occurrences. And it becomes incredibly emotionally difficult to sort of sit through those drawdowns. So the argument that everybody always makes is just to hold on to your assets. Don't buy them, store them, or buy them and store them. Don't trade them. And at some point in the future, they'll be worth a lot more than they're worth now. And that's in theory, a great strategy. It's certainly over the life of Bitcoin has worked well. But there's sort of this psychological reality where it is incredibly more painful to lose money than it is to gain money. And so you begin to have that 40, 50, 60, 70% drawdown, and it becomes sort of this existential question: am I the dummy in the room? Am I the sucker in the room that just bought the top? And so that's a big challenge. And I think we saw a lot of people sort of get turned off on the space as a function of that in 2018. And then 2019 sort of repeated the cycle all over again. We saw Q1, Q2 of 2019. We went from sort of mid 3,000s up to 14,000 or so, only to drop right back down at the end of the year to low low. So this is a repeated cycle, and it's just part of the reality of the space. And it's the reality that this is a speculative asset class where price is driven predominantly by fear and greed and less by sort of fundamental value. And that reality creates these boom and bust cycles. So we've also had this interesting drumbeat. So if it's not retail, we've had where's the next capital flow come from? And we've had this drumbeat in the space that institutional money is coming, and institutional money will sort of propel the next big bull wave. And that drumbeat, that mantra has been shouted over and over and over since I joined the space in sort of mid 2017. And by far and large, I don't think it's materialized yet. I think it hasn't materialized for a couple of reasons. One, this asset class sort of exists in a really opaque regulatory gray zone. Many of the larger hedge funds, it's still not necessarily legal or compliant for them to hold spot coin. And so or it's just not sort of applicable to them in their private placement memorandums with their LPs. And so you see sort of a lot of challenges for traditional institutional investors to enter the space. There's also liquidity concerns. I think this space, there is significantly less liquidity in these markets than many people believe. And so if I'm a $100 billion fund and I want to allocate sort of 1% of my portfolio into digital assets, how do I do that without causing incredible impact to the market? Like it's just not necessarily possible. So if I can't make that size of investment in the space may just not be worth my time yet. And so I think we're waiting to see a lot of that. And then again, on the regulatory side, I think we're waiting for many entities to get further clarity from organizations like the SEC, or for us here in Washington State, that the DFI, on how those regulators are going to treat the space. We need clarification on custody rules. We need clarification on licensing for exchanges. There's a lot of work to be done with the regulators to permit sort of these institutional investors. And sort of the most popular narrative that we see is this notion of a Bitcoin ETF. This notion of Bitcoin ETF has been going on and on for months or years, to say that the approval of an ETF from the SEC will be the catalyst that this industry needs to sort of see the next bull market. And the SEC has consistently been denying an ETF with sort of every approval window that's come up for the last 2.5 years, which is kind of interesting because the reports on that largely have been making the argument that Bitcoin is too volatile and there's too much market manipulation for the SEC to approve an ETF. But actually, if you go look at the volatility stats of Bitcoin on a sort of a month-to-month or quarter-by-quarter basis, and you compare that to some of the volatility in the stock market over Q1, Q2 of 2020, arguably Bitcoin has been less volatile during certain periods of time than the traditional stock market. So that's all to say. We don't know sort of where the next capital coming into the space is going to come from. Certainly retail has been the primary driver historically. Institutional capital has a lot more sort of dry powder per se, and can make a lot more of an impact. But until those regulatory barriers are cleaned up, it'll be interesting to see if we actually see that manifest.
Sure. I think Jesse touched on a lot of things that, I definitely agree with. The one thing I kind of would add, 2 years ago, when I kind of joined 2.5 years ago, again, just like Jesse said, there was a lot of, retail focus, a lot of spec, even with like kind of the smaller institutions that we used to service in the old company, there's been like a lot of kind of speculation. You buy some Bitcoin, you buy some Tron, you buy some whatever, and you kind of hope it goes up and you sell it, right? Now, what I've seen more recently, as the types of players that are in the crypto markets are kind of a little bit more institutional, a little bit more sophisticated, folks are starting to use their Bitcoin for different things. Luckily, I sit as a custodian where I kind of see these things firsthand. So, folks are using their Bitcoin in storage that, it can serve as, for example, as collateral for a loan. So, you kind of have your Bitcoin and it sits there and you pledge it as collateral, and then, we can issue like a USD loan for you to use, and that's good because, you have a fully secured loan with something that you would hold anyway, and it's just basically an easy way for you to, avoid, the tax implications of selling that Bitcoin and then borrow, getting dollars that way. So that's like one use case, right? And like I said in the previous, statement that I made, there's a lot of kind of like macro hedging going on, and Bitcoin is used kind of that way, right? So I guess that's kind of a way to say that the players have been getting more sophisticated. I think Jesse also touched on the fact that the derivative markets are getting more sophisticated. Like 2.5 years ago, I think LedgerX had like a few options out there, and BitMEX was just kind of launching their perp swaps. Nowadays, you have CME, doing options, and you're doing futures. You have BitMEX volumes are some of the highest, out of all the crypto exchanges out there. You have things like Deribit, and I can keep naming these types of things. So a lot of that has been advancing pretty heavily just over the last 2 years.
And Yuriy, I know this is something that you touched on that earlier during one of the first questions, but Jesse, do you mind giving a little bit of a high-level synopsis of the Bitcoin halving before we dive into those questions for those in the audience that may not understand or know?
So March 12th, what the crypto industry calls sort of Black Thursday, that was sort of the first big test. So in that instance, the price of Bitcoin fell sort of 50+% over the course of 2 hours. And many of the miners got margin called as part of their lending contracts. Based on the conversations we've had with lenders in the space, so all of the miners were able to sort of meet those margin calls. So there were no liquidations, which I think is a testament to sort of the sophistication in which they're managing balance sheets. I think that's a really helpful thing. So that was sort of the first concerning red flag. What we're seeing now, so the way this mining industry works, you effectively buy this specialized infrastructure, you depreciate it over a period of time, you pay for electricity sort of in real time. And so your cost of production is your depreciation plus your electricity cost. And depending on where you are around the globe, that cost of production can be different, but it's arguably around $7,500 to $8,000 a coin right now. It could be a little higher, it could be a little lower. Right now, as we're recording this, Bitcoin is in the high 9,000s. So it continues to be profitable for these miners to mine the network. It doesn't take that much. It could take another March 12th to drop that price down to the point where these miners can't secure the network. And if the miners can't profitably mine Bitcoin, there's no incentive for them to do it anymore. They turn off the mining equipment. And at some point, if you turn off enough mining equipment, the network sort of ceases to function. So many people will talk about Bitcoin to say it is sort of it has been around for 10 years. It's never had an outage. It's the most resilient, reliable chain. It has the most mining infrastructure. And these are all true things. But we have to recognize that this is still sort of still a technology experiment. It's still a monetary experiment. And that the halving itself doesn't necessarily mean that the price goes up. There's
just to add to just mining, what I've seen, on crypto Twitter and just elsewhere in the crypto media is that, the halving's coming up and folks are looking to kind of game it. The inflation is going to be less, therefore Bitcoin is going to be worth more, right? But I think what a lot of people don't think about, there's this big argument like, well, is it priced in? Is it not priced in? But I think because the halvings are predictable and you know exactly kind of when they are, I think just mentioned, they're about every 4 years. Obviously it goes by the number of blocks, but it's about 4 years that the halvings occur. That, I would say that this stuff's, pretty priced in altogether. There's obviously other variables, Jesse touched on mining, energy costs, the marginal expense for a miner to actually stay in business, et cetera, right? Whereas, in traditional markets, you have zero idea when the Fed is going to do what. I mean, I think if you look at, a year ago, Jerome Powell said he's going to tighten 3 times in 2019, and we all know how that went. And this is before COVID. And so I would say that the halving is good because it is just predictable. It allows market participants to basically operate knowing the fact that the halving is coming and exactly what's going to happen with it and the supply of overall Bitcoin.
Recently, the stock to flow analysis has received a tremendous amount of attention in the industry, particularly as the basis for predicting sky-high future Bitcoin prices. Can you describe the model for the audience, what you make of it, what you value, if anything, does it have for investors in the space.
Yeah, absolutely. So stock to flow is a model that has been produced by this gentleman named Plan B on Twitter. So this anonymous Twitter character. And it basically makes the assertion that the value of Bitcoin can be derived from this measure called stock to flow. Stock to flow is effectively the inverse of inflation. And so this gentleman has done some analysis on different asset classes like gold and palladium, looking at their stock to flow values, and then correlating that to Bitcoin's value historically to create a model to project sort of future state Bitcoin price. We're in the final stages of a research piece that we'll have published in the next week or two that talks about this model from both a sort of a theoretical perspective, like what is it actually measuring, and then from a quantitative perspective, looking at the actual math. But the reality is this model is more of a marketing piece than an actual functional model. We think of it really as a chameleon model to some extent. The correlation, it's funny. There are all kinds of sort of correlations you can go find online, looking at things like divorce rates compared to margarine utilization, or one of the other funny ones is every time Lil Yachty drops an album, the price of Bitcoin drops. It's really easy to find correlations in statistical data, but it doesn't necessarily mean those correlations are accurate. And so understanding sort of what drives the models that you're looking at becomes really important in our eyes. So at the end of the day, again, I think Bitcoin's fundamental value it's not necessarily shared amongst market participants. The reason that I value Bitcoin and the reason you value Bitcoin and the reason anybody else in this space values Bitcoin, it's all structurally different. And that makes it fundamentally more of a speculative vehicle than anything else. And speculative vehicles require that somebody tomorrow will come in and buy my asset for more than I bought it for yesterday. And so that stock to flow model from our eyes, it's a sophisticated marketing piece. It's a way to drive that FOMO that pushes so much marketing, that pushes so many retail investors to participate in the space more than anything else. And we think it's really important that people should understand sort of the nuances of that model. So we're looking forward to sharing that research over the next couple of weeks.
So note to self, when Lil Yachty drops a new album, do not go and buy Bitcoin.
Just making it a bit of a broader answer here, because I think, Jesse covered stock to flow pretty well. Fundamental models as they relate to Bitcoin, are interesting. There's things out there like, network value, Metcalfe's law, things like that. That are used to value Bitcoin. There's a lot of mining statistics that get published. So, that could be considered a fundamental analysis, right? But I think the point that Jesse made that's the most important here is that, a lot of different people value Bitcoin in different ways, right? Some people do it as simply as, hey, like this chat room has a lot of, positive chatter about Bitcoin, which means it's going up, right? Or something very complex as like, there's a lot of Medium articles that are very scientific that are written about different types of models to value Bitcoin. Which ones are right? Which ones are wrong? Hard to say, right? But I think as the space kind of develops and there's more kind of historical data, there's a bigger ability to backtest certain models versus other ones. I think we'll find out just like over the next decade, 2 decades, and so on and so forth. Of which models are good, which ones aren't so much. It'll come with time.
I guess I'll be buying some Bitcoin when Lil Yachty releases his next album.
No, it drops when he releases the album. It's the wrong time to buy. I gotta wait.
Recently, Goldman Sachs put out a statement saying that Bitcoin and even crypto as a whole is not an asset class. What do you make of that? What will it take to get some more skeptical traditional players to see the light here? Jesse, you can go with this one.
Yeah, this is an interesting piece. So Goldman a week or two ago did a sort of client-wide presentation, which I think is interesting because it's been a while since Goldman sort of acknowledged Bitcoin or talked about it more broadly to the clients. So to me, that says clients have been asking, and I think that the crypto community was looking forward to that presentation, believing it was going to be a pretty validating moment for the space. And then Goldman, once they started, pretty quickly tore apart many of the sort of fundamental values that a lot of the space would purport that Bitcoin has. And so I think their quote was that they did not see Bitcoin or the cryptocurrency space as an investable asset class, and that they saw it as a sort of a speculative asset class. You know, it's interesting for us, we actually sort of agree with that perspective. I think most of the assets here, again, because this lack of fundamental value or shared fundamental value, the price action is driven by speculation, it's driven by fear, it's driven by greed. And there are certainly ways to benefit and profit from that. Many people in the industry have made a significant amount of return speculating on those characteristics. But in terms of saying that this is an investable asset class, we share that belief. There's many people that will say sort of you buy Bitcoin and you sit on it, and that will be a great investment in a decade. And in our eyes, that's sort of like saying back in 2000 that you just need to buy Yahoo stock and sit on Yahoo stock for the next 10 or 20 years, and that'll be a great investment. We're in the midst of this huge technology experiment and financial experiment, and nobody really knows how it's going to play out. And so to say that any one thing today will be the winner tomorrow feels, in our eyes, a bit of a naive perspective. There is so much uncertainty into how these protocols will work, how they will evolve, how they will secure themselves, sort of how their censorship resistance works, how governments will react. That in our eyes, you really need to be sort of an active market participant to benefit from this space. To some extent, participation here, it's like liquid angel investing. These are each one of these currencies in this space, to some extent, is like a startup company, and they all have their pros and their cons, and they've all have sort of different levels of sophistication, and they've all been around for different periods of time, and they have the benefit that you can that they have liquidity, right? Like you can't necessarily go as an angel investor or a venture investor in startups. You can't actively trade the equity that you're holding, but we have that benefit in this asset class. So to some extent, our belief and our position is that this really, it takes sort of active consideration and active participation to be successful here, and sort of this notion that buy Bitcoin and sit in it for the next decade and you'll be successful, in our eyes, isn't necessarily the best approach.
Yeah, I think one thing that's being missed on a lot of Twitter and a lot of analysis of this Goldman statement is that it was published by Goldman Sachs Asset Management and not their research unit, right? You know, I spent 10 years over at Goldman Sachs Asset Management, you know, I think Jesse's 100% right. It's obviously clients have been asking, and that's probably why they came out with this, you know, kind of presentation and had this call. You know, just given my kind of history there, I'll probably not comment too much on this, but I think there's a really good tweet storm by Jill Carlson that came out, and that's basically my stance on it.
You know, one last note, and I think this is really interesting, and we've seen a lot of this, we've had a lot of this conversation with different investment managers in the space. Like, the reality is Goldman Asset Management makes their money by AUM that they're managing. And when individuals buy Bitcoin, that sits outside the realm of assets that Goldman can bill for. This is sort of similar for most RAs in the space. So there is this inherent sort of conflict between them recommending an asset that they cannot actually sort of custody and charge for today, that can often taint the lens of the recommendation. So always something to keep in mind when you look at something like this. And I think Yuriy's point that it is from the asset management versus the research arm is an important one.
And having both been in the crypto space for a few years, how has this tech in this space evolved? And what new or newer tools and protocols are you excited about?
So 2 years ago, when I joined crypto, I think the tools were not nearly as well developed as they are now. At my first fund, we used a lot of kind of Jupyter notebooks, a lot of kind of stuff that's not very front end developed systems to do a lot of our accounting, to do a lot of our settlements, et cetera, right? And if you try to look for an accounting system that can serve a hedge fund, I think it was tough to find something that would fit, right? I think today, if you visit, any kind of large crypto conference, you will see that, there's a ton of booths around. Folks are offering order routers and accounting systems and order management systems, you name it. And there's probably 4 or 5 companies that do every one, right? At Anchorage, when we were looking at execution systems, last year, I think we looked at maybe 9 or 10 different companies that all had like very well developed systems, right? But 2 years ago, this wouldn't have existed. We probably, at Galois, we had to build everything mostly ourselves, just because there wasn't really a lot of stuff available from third-party providers. So yeah, definitely been a lot of development in the space. I do think that there's still a long way to go. A lot of the APIs as well have been developed pretty well by most crypto participants. Every exchange I approach now, most OTC dealers, they have some sort of an API integration that we can do. So, you can do a lot of programmatic trading and programmatic settlements and everything that kind of goes with it.
It's been really interesting on our side to kind of take a look at this. So 2.5 years ago, we entered the space with the thesis that the tools really weren't there for institutional traders, and that a big part of our differentiation would be to build that tool set. And for example, like little things, like we trade everything over the counter. So we work with third-party market makers to buy and sell all of our assets. We found for our style of trading, we get better execution, and arguably it's more secure for us because we can keep our assets within custodian or in our bank and do net settlement T+1. It just has felt like a better style to execute trading. That said, 2.5 years ago, OTC trading was all done in Skype chat rooms. So I would have 3 or 4 counterparties, and I'd get in and I'd say, I want to buy $1 million of Bitcoin, and I'd copy and paste that across 4 rooms, and I'd try to coordinate all these different responses. And by the time I was ready to execute, the price would have changed. And it was shocking to us that was sort of the state of the art in this space, and that hundreds of millions of dollars are being traded that way. Over the course of the next 2.5 years, that's gotten more sophisticated. And now, as Yuriy mentioned, we've got APIs and we have connectivity to a number of different desks. And so now wall trading continues to be done OTC, but it's done electronically over those APIs instead of in chat rooms. So we definitely are seeing sort of a more sophisticated set of tools enter the market. I think that the challenge is for most funds that most of these offerings and tools and capabilities, they're all sort of piecemeal. So I can go and I can buy I can get data from a provider. I can get order execution from a provider. I can get sort of portfolio management from a provider, but none of that really ties together, and it's all fractured. And that's been our biggest shock. So we've ended up spending the last 2.5 years building a software platform we call Octopus that tries to bring all of those pieces together. So Octopus has data ingestion, it's got order execution, it's got systematic sort of algorithm. It's got systematic algorithm. What am I trying to say? It's got systematic signals that are driven by algorithms to order and rebalance the portfolio, and sort of settlements, reporting, LP accounting. So all of these pieces that are required to actually effectively and efficiently run a fund, we've built from the ground up. And we think it's a pretty unique differentiator. But it's sort of this interesting state of affairs that's what's required, that you have to go and build all of that from scratch in this industry in this day and age.
So no more Skype chat room for exchanging.
No more Skype chat rooms.
So some of the similarities and differences, what are some of the similarities and differences between the traditional asset classes and crypto assets when looking at custodians?
I think this question can be started with, like, what does the custody space look like in traditional Wall Street, right? So, if you look at the space, you will see that the custodians are just these giant conglomerates whose like 90 to 95% of their business is literally just custodying of assets. You think of players like, Bank of New York Mellon, State Street, Northern Trust. There's a few other ones that are pretty sizable. And their business is literally just to hold assets on behalf of asset managers, hedge funds, individuals, banks, government entities, whatever, right? And the reason they can do that is because, like a share of Boeing, right, is pretty much the same thing, technologically speaking, as a treasury bill, right? It doesn't require a lot to house both in the same company, right? You just need different groups who just understand the flows of those products and how they're kept and how they're kept track of, and then build out pipes to different brokers, et cetera, to receive signals of where to send these things and how to reassign them, right? Now, if you look at crypto custodians, you basically have a different technological build out for just about every asset, right? So for example, to build the infrastructure to hold Bitcoin, you have to do one sort of technical build, and then to build out, let's say, Litecoin, it's a completely different build, and you have to have engineers that specialize in both and that can maintain those assets at the custodian. So the more assets you add in a crypto custodian, the more technically proficient you kind of have to be, right? So going back to a traditional model in Wall Street, a lot of the brokerages are they're located at sell-side divisions of the banks, right? So the big brokerages are with Morgan Stanley, Goldman, and so on, right? While in the cryptoverse, because of the technological security aspect of it, it makes a lot of sense for a brokerage to be built on top of a custodian, which is exactly the Anchorage model. You can see some of the other players in the space are kind of doing the same thing, because at the end of the day, crypto is a bearer asset and security is what matters most, right? So it makes sense for, if you're a client that holds, assets at custodian X, it makes sense that you can trade it at custodian X so that your, operational risk, your security risk is kind of minimized. So I think that's probably the biggest difference, is just like how the brokerage versus custody is just set up in both environments.
And Jesse, what are some key factors that best relate to your use cases when evaluating custodians for investor portfolios?
Yeah, this is a fascinating one for us. And so we in Washington State are working with the DFI. To be an RIA, a registered investment advisor at Washington State, you must custody all of your capital today with a qualified custodian. So we have to take all of the capital that we maintain for our LPs and ensure that it is stored and safe with qualified custodians. We're also an actively traded fund, so we make, in some instances, dozens of orders a day across 6 to 8 counterparties, and so we have capital flowing on a pretty regular basis. And so the issue here, and particularly this is a broader cryptocurrency issue, if you make a mistake transmitting funds, your funds are gone. There is no sort of recovery. And so that security and that sort of approval layer becomes really important with the custodian. But at the same side, it becomes really important to ensure that transactions can be sort of submitted and deployed really quickly. What's been fascinating for us is ensuring these custodians can come up with a solution where we can submit and process withdrawals with a distributed team in a really timely way and in a secure way. So for us, we use multi-approver processes in our withdrawals. So we have multiple team members that need to have eyes on every transaction. And having a custodian that made that process very simple and quick was really important, but didn't give up the security that we really value sort of in the midst of that.
Yuriy, anything to add versus Jesse's answer?
No, I think Jesse covered it pretty well. I would just leave it there. Yep.
Cool. Well, coming up on the top of the hour, I want to make sure that we get in some audience questions. We'll start with this one. Are tech stocks turning into the fiat inflation hedge we thought Bitcoin would be?
Yeah, I can start off with this one here. I think this question is a bit difficult to answer because, what do you consider tech stocks, right? Is it the social media platforms? Is it, robotics companies? Is it, what exactly is it, right? I think some of those subsectors of the tech industry definitely fit that, while some aren't. And if you think about it, I mean, look at the current environment, right? We're just kind of in the midst of this kind of lockdown, COVID era, right? So it makes sense that a lot of these tech companies that facilitate, folks working from home, facilitate just isolation, social distancing, et cetera, are obviously going to go up. So they're probably a good hedge against, I don't know, a portfolio that's probably made up more of like industrial stocks, right? So the answer to this question is yes, but with a caveat of, you got to kind of just stratify the tech industry in more subsectors.
And next question, whenever people talk about crypto prices, it's usually against the US dollar or another major currency. With what happened with oil futures going negative and it's tied to the US dollar via the petrodollar, in addition to the Fed QE, do you foresee a world where underlying denominations change, / how would that look? Jesse, you want to take this one?
Yeah, I mean, this is sort of a sci-fi question to some extent. It's like, at what point does the US dollar sort of lose its reserve currency status? What does the world look like in that scenario? And does Bitcoin sort of become that global reserve currency? It's an interesting thought experiment. I don't know if there's any way to predict if and when that ever happens. And we can get really out there and think about, like, hey, if there's a settlement on Mars, what currency do we use to transmit capital between the two civilizations? It's hard to say. Certainly the global reserve currency has shifted every so often over the history of reserve currencies. So there's certainly precedent for things to change. It's just to make the argument that Bitcoin becomes that component. I don't know. I can see it play out both ways.
Yeah, just to kind of add to that, Jesse mentioned that, no reserve currencies ever kind of survive the test of time, right? So I think one of my favorite books that I've read, last year, was Ray Dalio's Principles of Navigating Big Debt Crises, right? And the whole book kind of is centered around the theme that, there's been X amount of reserve currencies in the last, let's say 600, 700 years, and every single one of them exploded at some point or another, right? And then the whole book basically just has these sections that, investigate like the hundreds of debt crises that happened in some sort of geography at some point in time. Some happen, the long-term debt cycle, as Ray calls it, happens over a 50-year time span. Some happens over, 100-plus-year cycles. So, which makes it interesting because, you as a trader, you kind of, traders are often, get better as their intuition builds, right? But if they're part of the cycle that's longer than their entire lifespan, it's hard to kind of understand, what happens without really being a true historian and understanding these things, which I think Ray does a great job of, right? So, when will this USD experiment, kind of come to an end? I personally think that it's going to be during my lifetime. As we've kind of mentioned in the beginning of this webinar, we're seeing kind of unprecedented money printing, by all the major central banks, right now, like this year, right? And it's been kind of happening, over the last decade, and exacerbated, especially this year because of the virus and, other things, right? So yeah, it's an interesting thing to think about. I think a lot of people have different opinions, but yeah, I do think it happens, during our lifetimes.
And we'll finish this last question. On the topic of scarce supply, with large players like Fidelity and Grayscale enabling both institutional and retail investors to invest through products like GBTC, what are trends you foresee in the derivatives market and how it affects the underlying asset? Jesse, you want to start with this one too?
Yeah. I think this is an interesting topic because there's this argument that Bitcoin is valuable because there are only 21 million Bitcoin. and that sort of that drives, that scarcity drives a lot of the value. That's a lot of what underpins this whole stock to flow model. That I think a lot of people will make the arguments that that's why they're buying it. That scarcity makes it similar to digital gold. The interesting thing here is that all of these derivatives markets allow people to sort of participate in the price action without necessarily having anything to do with the spot price. So all of the CME futures products, those are all cash settled. And so there's sort of no spot Bitcoin involved. Many of the sort of offshore, sort of non-regulated derivatives products, again, sort of give you the ability to trade on pretty significant leverage that could cause a lot of impact to price without actually sort of having the market participant hold the underlying spot coin. So many of these products, I think, are creating the situation where that 21 million Bitcoin argument really isn't actually valid, that there are sort of significantly more avenues and mechanisms to impact or modify Bitcoin price outside of holding traditional spot. It's kind of a fascinating paradigm that's been created, quite frankly.
And I'll add to that as well that I think there's pros and cons to this effect, right? So what I mean is, like, just because there's a lot of let's say open interest in the CME with Bitcoin futures, I think that helps with price discovery, right? It helps with liquidity, which I think is a net good for the market, right? But if you look at some of these like 100x leverage places, maybe it's not so good, because if the price of the physical coin goes down, then you have all these liquidations, which forces the forced sale of collateral, which further forces down the price, right? And if you ever look at just most of the big Bitcoin drops just in history, or at least in the last 3 years, while a lot of these kind of 100x exchanges have been around, like you'll see somebody dump a bunch of Bitcoin, it goes down a little bit, and then you start seeing these cascading liquidations, and it kind of goes really down, and then it kind of bounces up to right where, at the level where the actual physical dump of the Bitcoin actually ended, right? So it kind of cleans people out from their leverage positions, then it kind of bounces up because there's a lot of natural buyers at those prices, right? So that's probably like not very healthy. Now that effect is a little bit exacerbated by the fact that all of Bitcoin right now, market cap wise, is I think the popular comparison folks make is that it's smaller than like a tenth of Apple or something like that, an eighth of Apple, I believe, last time I checked, at the current 9,600 Bitcoin price, right? So once Bitcoin is owned by more people, and the price is higher, I think these exchanges and these forced liquidations from unwinding of leverage positions will not be quite as impactful. But until then, you'll still see these effects in Bitcoin, as long as you have these kind of futures and other kind of proxy Bitcoin models out there.
Great. Well, with that, thank you everyone for coming, and have a great afternoon.
Thanks, everybody.
Yeah, thank you.